Bond market is pricing in cuts into the back half of next year, despite the Fed members all saying, don't count on it. Inflation is still too high. We haven't seen evidence that inflation's falling fast enough in the areas that matter. Things like core services, ex-shelter, still running at 6%. So the bond market pricing in those cuts seems to be similar to this summer, where we saw something also happen, where the bond market started pricing in cuts into the beginning of next year. And the end result was that it was caught flat-footed, and that's when we saw yields start to rise again.
So who do you think wins this battle? Clarida suggested that, in his words, the market's going to have to come up to the Fed, not the other way around. Do you see it that way?
I think the answer is that, yes, the market will have to come up to the Fed because inflation is the new wild card here. If this was 2018, when inflation was benign, the situation was that the Fed could step in and support markets. But the end result now is that with inflation being so high, they have to push back against this pricing.
Maybe the bond market, and Clarida's point also, was that maybe the bond market thinks the Fed won't have to be as aggressive because inflation is in fact coming down, rather than the other way around, which would be that it just doesn't think the Fed's going to be able to do what it wants because the economy is weakening too much.
Well, I think it all depends on the path of the labor market, because at this point right now, we're seeing no sign that the labor market is weakening enough to have the Fed step in and support markets. But there's something important to remember with the 2-year. The 2-year now is sitting at 4.2%. You go, how can you square that with a Fed funds rate at 5% of what they're projecting for 2023? Well, because the 2-year is at about 4.2%, that's about where the Fed is for 2024 dot plot. And so that's what that is already starting to price in.
Well, Michael Hartnett of Bank of America today said that you're not going to get a bottom in the market until the labor market cracks. And I mean, the implication in that is that that's going to take a while.
Yeah.
Right? It's so strong, as you say. It's such a lagging indicator. Until it actually does crack, you can't even declare that the bear market is over and that we can even start a new bull market. That's suggestive of some significant pain still in the cards.
And significant time that could still be in the cards. If we go back to pre-Great Financial Crisis, the Fed started raising rates in 2004. Unemployment didn't start ticking up until 2008. Now, it doesn't have to take that long this time around, but if we think about the labor market being the driver of consumption, consumption being the driver of growth, growth being the driver of earnings, then it's likely we don't get that earnings recession until we see the labor market start to really weaken.
You think we're going to retest the lows, if not break through them?
Yes. Yes, I do think we will. Now, it might not happen immediately. It could happen sometime in the first quarter, but I do think that given the fact that we were just trading at 18.6 times earlier this week, this is not a cheap market, and estimates still are rather high. So if they start to reflect what could be a weaker economic scenario and we get a valuation that's more consistent with where yields are today, that would point to lower markets.
I mentioned at the very top of the program that Guggenheim's Scott Minerd is suggesting a trade for all of this, in which he says, and I'll show everybody the tweet, which came down not too long ago today. Latest New York Empire manufacturing, retail sales, Philly Fed Index, industrial production, all confirm Fed tightening is slowing the economy. Resistance at 4,100 on the S&P shows the downtrend in equities firmly in place. Opportunity to reduce equity exposure or establish a short position. You guys are in sync, I think.
Yeah, we've been talking about this discipline around the 200-day moving average, and that's about where his 4,100 is, which is that when you trade up close to that 200-day, when you're in a bear market, you want to be reducing risk, reducing exposure. But when you get oversold versus the 200-day, like we were in June or in October, that's when you don't press your shorts. And so I think having that discipline around the trend line, around that 200-day, is very, very crucial as we navigate the market.
So when some would suggest, well, if bond yields are coming down, that's actually pretty good for stocks. Not if they're coming down for the wrong reason, which is probably what I would guess you would say because of the concerns about going into a recession.
Exactly, because if bond yields are falling because we are pricing in imminent rate cuts where the Fed is having to respond to much weaker growth, it means that we have a big earnings hole that we haven't priced in yet. And that's similar to what happened in 2018. We saw a rally in bonds at the end of the year, but equities did poorly because bond yields were falling for the wrong reason.